Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge funds, portfolio managers, family offices. We help people get better returns in the equity portion of their portfolios. Last summer, we did a call with Chris Bell and Peter Doyle of Horizon Kinetics on Bitcoin. And we wrote on Bitcoin with a piece titled "Why We're Buying Bitcoin When It Was at 15,000, roughly 1/4 of the current price a few months ago." Since then, we've been getting a ton of questions about Ethereum, Litecoin, basically all of the non-Bitcoin cryptos we should be looking at. And so we decided to bring in a team of experts to talk about it. On today's call, we have Chris Bell, who's a managing director and national sales manager of Horizon Kinetics. It's a $5 billion asset manager with a cryptocurrency fund, and they've had huge positions in Bitcoin, hundreds of millions of dollars for years. They were early in the space. We're also very happy to have Michael Bucella. He's a partner at Block Tower Capital. It's a cryptocurrency hedge fund. Their returns have been absolutely incredible. And unfortunately, we were supposed to have Matthew Edwards of Delpha Capital Management. They are a multi-strategy fund focused on digital asset strategies. Michael had a dental emergency and is not going to be able to be on today's call. So we're just going to jump in. And Niles, we can shut off the video for everyone who's not Chris, Michael, or me. Howard, great to see you. We're gonna cut your video though. Thanks for being on the call. Chris and Michael, thanks for making the time. Chris, I'm gonna go to you for the first question. The first question we always get from people are, what are the factors that determine a quality coin versus one where you wouldn't want to invest? So in the non-Bitcoin cryptocurrency space, what are the factors that you look at to determine where you'd want to make an investment?
So one of the things that I look at, and we as a firm look at, is the economic policy. What is the rate of growth of coins in the marketplace of a specific cryptocurrency? Now, keep in mind, there are over 4,000 cryptocurrencies. So you have to have some sort of rules and starting points with each cryptocurrency. There are certain things that we like and certain things that we don't like, certain things you have to consider. But you need starting points. So the first starting point with us is we want to see scarcity. So a coin like Ethereum is not necessarily scarce, whereas a coin like a Bitcoin fork, Bitcoin Cash, is scarce. So another thing that we tend to look at is whether or not the cryptocurrency itself is solving a problem, sort of something like a chain link, which is moving off-chain data to on-chain data and decentralizing it so that there are no, in essence, honeypot oracles that can be corrupted. We like companies like that. In addition, you want a strong network. So I realize this is non-Bitcoin, but Bitcoin has the strongest network, and then you start going down the line from there. Ethereum has an extremely strong network. But it is somewhat centralized because it is proof of stake instead of proof of worth, or a proof of work. So proof of stake means you actually have to stake in order to mine. And the more you stake, the more the ability to mine. So proof of work is a very robust method of mining that takes a substantial amount of verification from not just the one person who mines each individual block, but everyone else in that decentralized, it's in essence a decentralized security hub. So those three things really are what we look at: the economic policy, proof of work versus proof of stake, and of course, if it's got a true use case, if it's solving some sort of problem in the world.
Chris, for the people on the call who don't spend a lot of time in the cryptocurrency space, can you just give a brief definition of what you mean by proof of stake? What does that mean?
So in the Ethereum network, in order to mine, you have to actually have to stake your coins. So you have to post your coins in what in essence is somewhat of an escrow account. And in order to maintain a certain level of mining, you have to do that. You don't have to do that for the Bitcoin network, for instance, or proof of work networks. Proof of work networks are very, very decentralized in their autonomy. Proof of stake, you have one central point controlling the proof of stake. So it's a little more centralized. So it's not as good, in our opinion, it's not as good as proof of work.
Gotcha. All right, Michael, I want to go to you with the next question. Two-part question. First, are there any factors you guys look at that Chris didn't mention? What would you add to the list? Second question, what are your favorite non-Bitcoin cryptocurrencies? Where should people be looking for value or appreciation? Also, I think you're muted. You're still muted. Niles, we need to unmute Michael. Hang on, Michael. Niles, can we unmute Michael, please?
All right.
All right. Go ahead, Michael.
Yeah, sure. So I agree with a lot of what Chris just said. I mean, for us, I guess the way we break down the space generally is Bitcoin is a macro asset and everything else is liquid stage venture. And so I think it's the use cases, community, and that's an attractive thing to have, right? To have the return profile of venture in a liquid format is the golden asset, right? So there are a few different layers of alternative currencies, altcoins broadly. When we look at our exposures, we look at, so basically liquid crypto exposure versus cash. And then within the crypto exposure, it's Bitcoin versus alts. But then within alts, there's a number of subsectors. So you have layer one protocols, which are smart contract protocols that engineers build decentralized applications. So they're the same as you would see with an application on your iPhone, except these are decentralized in nature, built on decentralized infrastructure. So those are things like Ethereum. That's the clear leader that's been around for the longest time. Most of the DeFi space has been built on the Ethereum network, for example. But there are other layer one alternatives, and that's been one of the emerging narratives of the last really 6 months. And those are things like Solana. Those are things like Polkadot. But Polkadot, you could even say, was a layer zero because you can parachain or bond layer ones to it. So I don't want to go too deep, but effectively, there are a number and an ever-growing number of altcoins. There are new ones issued every single day through traditional liquidity from venture investments, but also through decentralized exchange offerings. So you've got new assets entering the market each day. Identifying them is, early on is what creates the most attractive risk return profile. This is a very global asset class, and so they're happening across the world at all times. So you'll have, I mentioned decentralized exchange offerings. You're seeing those across, in exchanges that are more Western hemisphere oriented, as well as ones that are more Eastern hemisphere oriented. And so it requires an enormous amount of underwriting and diligence by an investment team. We have a team of 12 folks, and I think we've been operating, when we were at 10% of the AUM we're at today, we had a team of 9. You kind of need to front run, or at least make that investment early on, because you need to identify those assets, give a, return profile you mentioned earlier about where we've gone year to date. So it is the wild west of the market. A lot of it is guerrilla warfare, and identifying the highest quality assets is what drives longer term allocation. So there's trades and there's investments, and those are very, very different strategies. And I think that's very critical to note. I think in the crypto space, people have a extremely short-term horizon, but if you actually just stick it out with some of the highest quality altcoins, you end up generating much more attractive returns, particularly when you tax adjust for duration. So we kind of do a bit of both, right? We trade short-term, but we also hold long-term. We look at it from a multi-strat angle.
Michael.
Gary, if I could add one thing, and that is that
Go ahead.
It's interesting to kind of compare in the marketplace how many coins there are versus, say, the number of publicly traded securities. So in the US, there are 3,500 publicly traded companies. Well, there are 4,000 crypto that are available. So it's just a massive task. What Michael's talking about, it's a massive task to try and understand each one individually and whether they have an investment function or not.
That's a great point. And one of the things as equity investors that we really love about Michael's comment is understanding the difference between trading and investing. That's to understand what your investment thesis is, what your time horizon is, what you're looking for. In our world, that's always the right approach. So great to see. Michael, I want to come back to you with a question that I originally had for Matthew, because you talked about Ethereum. We're getting a lot of questions about it. I know Matthew's very positive on the network there and the other possibilities. What do you think is better about the Ethereum ecosystem? And how do you decide to size a position like that?
So all sizing is dependent upon liquidity and anticipated liquidity, right? Because liquidity is a coward, and if and when you need it, it typically is not there. And so with Ethereum, there is significant liquidity. It's probably within the top 5 in terms of liquid assets. You also have Ethereum futures, both regulated and unregulated, which allow you to get, I would say, allow you further hedging capabilities if you decide to size up the position. The reason why Ethereum is a clear leader in layer 1 smart contracts is just 1, duration, 2, it is the most decentralized of all of the layer 1 assets and altcoins. And that has created network over time. It's I would say, like I said earlier, the majority of DeFi has been built on Ethereum. The only really driving factor away from the ETH infrastructure, the ETH ecosystem, was gas fees, and that was a function of usage on Ethereum. So as usage increases on Ethereum, as the world pivots towards DeFi, gas fees, which are used to execute Ethereum smart contracts, spikes, and the ability to transact in small amounts becomes effectively moot because you're paying enormous fees to transact. You'll pay $1,000 to transact. So that was the driving factor to alternative layer 1s, and that was that kind of Q1 emergence of, as last year we talked about the layer 1 battleground that we of course saw coming. We were not the only ones. I don't want to act like we were the Nostradamus. There were a lot of folks discussing this. The Ethereum community has been discussing it for a while. We saw the same type of congestion in late 2017 when a DApp called CryptoKitties basically brought the Ethereum network to its knees, and that founder, who we've stayed very close with, has created another protocol called Flow, which is actually built for viral gaming decentralized applications.
I've been trying to buy Flow for about a month now. It's Flow is what makes NBA Top Shot go, and I've been trying to buy Flow for months to get away from the fees, the credit card fees.
Yeah, it's so we Dieter, who's the CTO and co-founder, right. We were friendly with him previously. We actually made him a technical advisor to Block Tower in 2017, and we invested in the round last July, and we took part in the equity conversion for Flow token. So right. that's where most of ours comes from. We've been selling our inflation rewards into the market, but we're I think like many, there's a large lock that's coming in October, which is interesting. As an equity group, you would think a large lockup would indicate a pretty dramatic sell-off. But if you're using Solana as an analogy, for example, there was a massive unlock in Solana in January, and it's gone nowhere but up. So it's an interesting dynamic. You have to stay very, very close to the players. There is a very strong inner community, and that will determine a lot of the capital market outcomes for these assets. So Flow, yeah. So as Chris mentioned, Flow is the blockchain. Flow token drives the Flow blockchain. That was the underlying blockchain for NBA Top Shots, which has been one of the most successful product launches in history. Certainly the most successful crypto product launch. And most people that interact with that, I grew up in New York, and I have friends in every part of the union system, sanitation workers and FDNY guys. And they're all telling me about the NBA Top Shots that they bought. They had no idea they were interacting with cryptocurrency. Right. And it's kind of amazing. That just shows you how good the team at Dapper Labs is.
I can't wait till each NFT has a ticket to watch Julius Randle warm up in the morning or something.
That's kind of that's the idea. I mean, we've actually just 3 weeks ago I had a call with Dieter and 15 sports team owners discussing the technology of NFTs and the intersection of sports team intellectual property. So there's a lot of emerging technologies coming out of this. Ethereum, going back to that, the Ethereum network, that congestion has created demand in other alternative layer 1s that are of high quality. And so you can't just say, I'm going to create a copycat of Ethereum and throw it out there and people expect people to kind of, to create a Schelling point and draw in developers, you need to have some sort of you need to have some identifiable feature enhancement from the alternative layer ones. And so you know, Ethereum right now is about to go through its London hard fork. It's solving for scalability. That will drive back towards ETH. That was kind of the trigger for the rally, alongside things like the Ethereum CME futures launch and just the general narrative of Ethereum becoming an institutional asset, which it hasn't yet, but it may.
Guys, let's go back for 1 second. I know we have some people on the call who, again, are not experienced crypto investors, but they're interested in the space. Can you help them understand the difference between a level 1 asset and a level 0 asset or other kinds of crypto assets?
Michael, sure. You're much more up to speed on that than me.
Yeah, sure. I'm happy to, and hopefully I can try and talk the right line. I spent 10 years in traditional assets, so I think I do a good job of translating what crypto is for folks from that area. Layer 1 assets, you can almost think of them as ecosystems. So if you're thinking about Apple, for example, and Apple stock, Apple is effectively a hub and spoke model, where the hub is the Apple ecosystem. That's their hardware, their form factors, and the spokes are all of their applications. One of those apps being the App Store, and then that bonds out into other applications. So that's kind of how you can think about layer 1s, is you create centralization around a particular decentralized smart contract protocol, and developers create decentralized applications as spokes out of that. So if you want to talk about layer 0, which are things like Polkadot, and that's a little bit of a marketing pitch, but it really effectively can be, because if you want to bond, which just means connect into the Polkadot layer 0 protocol, you can do it through a parachain. You have to acquire a certain amount of dots, then you bond. So if you think of it that way, you can say Polkadot is Apple, Ethereum is the App Store in that scenario, and the dApps on Ethereum are the other applications out of the App Store. So I would say we're not there yet. I would say very much, you know, Ethereum is more the Apple than something like Polkadot. But that's kind of the way that I would translate it. And I literally came up with that just now on the spot. So if it sounds completely absurd, please do let me know. But that kind of is the way to best about layer 1s, layer 0s. Layer 2s are actually primarily just solving congestion issues on layer 1 protocols. So as a transaction is being processed, a layer 2 will basically take the transaction off that blockchain, facilitate the transaction or math or whatever that particular contract execution is, and then put the result back in the blockchain. So the work is being done on layer 2. The result is on layer 1. It allows more throughput on layer 1, and you move forward. But that just, all of this goes to show you how early the technology is. So again,
it's Lightning. The most notable one is Lightning Network, right, Michael? I mean,
yeah,
Lightning, which is the Bitcoin secondary off-chain side chain.
Yeah, and that was started by a woman named Elizabeth Stark. She's actually also on our advisory board. They've been working at that for years. It's a throughput solution for Bitcoin. Right. There is no associated token, but it enhances the broader Bitcoin ecosystem. So that's the Lightning Network.
Gotcha. All right, Chris, let me go back to you. What % of your crypto portfolio is non-Bitcoin crypto, and what are your favorite positions in the space?
Less than 5% is I'd say maybe even less than 3% is non-Bitcoin. My belief all along has been, if Bitcoin doesn't work, nothing else is going to work, and if Bitcoin does work, everything else is going to work. So everything that has a function, that has a real use case. So, I'll just give you a list of ones that, off the top of my head that I like. The biggest are probably Ripple, Bitcoin Cash, Bitcoin SV, Bitcoin Gold, Bitcoin Diamond. Those 3 Bitcoins are all forks off of the Bitcoin protocol. I own some Monero and some Zcash, which are anonymous coins. I own a little Mana, which is Decentraland's currency. I own a little bit of Litecoin, a little bit of Chainlink. I own some Ethereum Classic, which is going absolutely berserk these days. I bought it 4 years ago for like $4, and by the way, I've never sold a cryptocurrency, very, very seldom. I believe just in buying and holding, because I don't consider myself to have any ability to be up against the Michaels of the world, who are putting a lot of more time into each individual cryptocurrency. So, if I find something that has, and if we find something as a firm that has an interesting economic policy and use case, we just buy a little bit of it.
What about you, Michael? What percentage of your crypto, well, your whole portfolio, I think, is crypto, but what percentage of it is non-Bitcoin?
Yeah, and Chris is what the meme culture today calls diamond hands. No sales. Yeah, so our fund, we manage roughly $1 billion in the crypto space, the bulk of that in liquid markets. And currently, and I would say a spot in time is not really reflective of our long-term views. We're pretty dynamic with our book, but we're currently about 77% alts, 23% Bitcoin. But again, I mean, we don't tie to a benchmark. We're not kind of looking at things via tracking error. So if we identify a bullish regime where we think Bitcoin will outperform everything else, we will pivot the book heavily into Bitcoin. If we think it's the contrary, which we've kind of been pivoted for the last 5 months, we'll have the portfolio more position aligned with how we are today. But for us, it's and the liquid markets are, to give you a rough idea, we've got about 70 names in our liquid book outside of Bitcoin.
Gotcha. All right. Question for both of you. I saw articles over the weekend talking about the probability that the Ethereum market cap would exceed the Bitcoin market cap. I think the word they used was the flippening. I have no idea if I'm pronouncing that right.
Got it.
Good.
That's right.
What do you think the probability is?
What Dogecoin just did to Ripple.
See, Chris, I was hoping we get through this whole call without that word being mentioned, but
I think it's important to talk about Doge for the simple reason that given its success recently and its $85 billion market cap value, it's actually creating its own ecosystem, sort of similar to what GameStop did. When GameStop went absolutely crazy, they were able to issue some shares and get some cash on the balance sheet. So, Dogecoin has actually gotten a few followers now, and it may actually exist as an ecosystem going forward.
Fair enough. All right, Michael, what do you think the probability is that we arrive at the flippening?
This was a conversation that everyone was having in 2017 as well. I think the market is very momentum oriented. I do not foresee the flippening happening, and that could change. Everything is very dynamic, but store of value is a massive use case. And there is a very clear and defined winner currently in Bitcoin. And there may be something that comes along that is maybe some order of magnitude better and displaces it, but the likelihood of that is declining every day. Smart contract protocols, I mean, effectively everything we do on a daily basis is defined by some sort of contract. Every action we take is if then. So that is a massive TAM, but I do think that there will be multiple winners to that, and it's yet to be seen how that shakes out. And so I would say in the near term, it'd be tough to see, although capital markets these days, you never quite know. I mean, if this is an equities group, you've seen some pretty wacky things in the equities market in the last 24 months that you would have never seen otherwise. Beyond GameStop, I mean, you're talking $50 billion companies with no revenues for 5 years, right? So I think with respect to what's happening in crypto, possibility, a very, very low possibility. And back to the Dogecoin, I always go back to, because a lot of cryptocurrencies are, some of them I should say, are what I consider to be commodities. And Jeff Curry, who's the chief commodity strategist at Goldman, I remember a line that he said to me a long time ago, which was currencies, commodity value, short term is driven by demand, long term is driven by supply. It's a very simple concept. Dogecoin supply is effectively infinite, which means long term there is very little to no value. Near term, it represents the network value of memetics. So what is the market cap of meme culture, of memetics broadly defined? And that's what Dogecoin is capturing today on the demand side. What they can do with that is create a community and a network strong enough to see out a hard fork of the protocol where they create some sort of burn mechanism or some supply defining mechanism that will then be able to retain at least some of the value created today through memes. Without that, I mean, listen, it's the most, I will say it's probably the most under-owned asset by institutional managers in our space. Not to say that there's many of us, but it is one that very few in the institutional crypto world are actually backers of.
All right, so we're going to go to questions from the audience here. Happy to mention that this call is being covered by the press. Michael Bodley is on the call. The street.com just started a new publication, the streetcrypto.com. Their flagship publication is Crypto Investor. We encourage everybody who's interested in the space to check it out. Michael was kind enough to just send in a question. And here's Michael Bodley's question. He wants to know that many institutional LPs he speaks with are still struggling with the basics of how to do due diligence on actively managed Bitcoin strategies. Bitcoin, of course, is the tip of the crypto iceberg, and they're seeing new buy-siders. He mentions Dan Loeb of Third Point, put money to work in decentralized finance now. What advice would the two of you give potential LPs looking to vet decentralized finance strategies? Chris, why don't you take the first shot, and then Michael, we'll go to you with the same question.
Having been early adopters of Bitcoin in the white paper, I would say that every sort of strategy like that begins with the use case, the white paper. But I find is my favorite resource is Grayscale and Grayscale analysts. You know, if you're an LP and if you're a a partnership and you're trying to, or a family office and you're trying to get exposure and you're not sure in what direction to go, Grayscale has a ton of information on their website, and I would just go look at that. And Horizon Kinetics has a ton of information on our website that we've written about various crypto assets. And we don't consider ourselves active traders, so we consider ourselves much more investors and on the DeFi space and the DEX space, the decentralized exchange space. We're really not analyzing or playing in that space. So maybe Michael is, but we're not. But I like Grayscale, and I like our general research as well.
Yeah, I would say, I mean, a real proper traditional ODD is required for DeFi. DeFi, absolutely, there is such a vast array of operational procedures that are required for a proper DeFi investment vehicle. So we interact with the DeFi ecosystem often and frequently. I would say you need to almost entirely do a full separate ODD and cybersecurity audit on an investment firm before you even think about the investment process behind it. If you're looking at a DeFi investor, if you're thinking about as an institution, listen, there's many different types of, there's very many different types of and formats of diligence. I would, if I'm being honest with myself, I think having Andreessen Horowitz and Union Square Ventures and Bain Ventures and others investing in us early on, that was created a very clean bridge to get through the trust hurdle of a new asset and a new GP. For a lot of investors, for us, but I mean, more recently, a lot of the investors we speak with, it is a proper ODD cycle. So, many months of underwriting, iterations and meeting separately on cybersecurity, operational due diligence, and investment team diligence. It's table stakes if you're putting any, meaningful capital to work in the space.
And I would add to that, length of time in the space is important too. And I know Michael's and his company has some length in the space. We opened our funds back in 2015, in the end of 2015. So, we've been early adopters, as is Michael's group. So you'd have more confidence certainly in a group like that. But it was interesting for me, Michael, I don't know if you looked at BlockFi at all, but I went to BlockFi and I looked at all the investors, and they gave me a ton of confidence in utilizing that platform for myself. It's a DeFi.
Yeah, I mean, the lending and borrowing space, we think about a lot. Obviously, we have we have a large balance sheet of assets that we're always being tapped into for lending purposes.
Sure.
there's a kind of a, as a traditional allocator would underwrite us as a fund manager, we would underwrite a counterparty to the same extent as with traditional assets. And, required rates of return are fairly high for, venture-backed startups effectively. And, the world is starved. The crypto world is starved for cash. And so funny enough, if you actually lent your Bitcoin out, you're probably looking at anywhere from 3 to 5% if you're of any size. If you lend your cash out to a counterparty, you're looking at closer to 6 to 7%. So it's pretty interesting, the dynamic of our.
It's easily explained by understanding the swap, the swaps that are happening. You're lending your cash, you're buying Gemini dollar coin, stable coin, Tether, some other stable coin, and you're lending it to somebody who's shorting it and going long Bitcoin or long Ethereum. And so it's very understandable what's going on. And it's actually created a wonderful yield market, and a lot of yield farming is going on. Yeah,
I agree. The market structure developed in a massive way in the last 18 months. But I think another actually point that I always make to allocators that Chris mentioned is you should lean towards funds that have seen a proper cycle in crypto, which means we're around before 2018. I think that's critical to understanding their internal operations and either solving for, in hindsight, what were errors, or having gone through that without significant systemic risk to their organization. Because I think that was a defining moment for the industry, and folks that kind of lived through that, understood it, internalized it, and actually developed out of it. So I tell, whether it's us or a number of other funds that were in this before for a full cycle, you really want to think about that, because everyone's a genius in a bull market. I think cycles are what differentiates, I think industry leaders from momentum chasers.
Yeah, again, Michael, I think your background in equities is coming through. We think about things in the same way. I like it. Couple of questions came in from crypto investor Adam Green. He wants to know, what are the tokenomics of Ethereum? In particular, why should adoption of Ethereum technology, even if it's widespread, lead to appreciation of the asset? Wouldn't a high cost of Ethereum slow adoption? Conversely, wouldn't the network want to increase the supply of Ethereum, thus lowering its price to speed adoption? Chris, do you want to take a first crack at that?
Sure. Let me just turn off this call. So the ERC20 protocol has created an immense amount of interest in smart contracts and the development of smart contracts. And you really need a piece of Ethereum, and you're utilizing the blockchain network when you do a smart contract. So in order to utilize the blockchain network, you have to have a fraction of an Ethereum involved with it. Plus, you're going to go through a lot of, I just saw someone today saying that they were doing an NFT sale that was going to require 3 Ethereum. So, we might be back, Michael, you certainly remember this, back to the ICO days, where in order to buy the ICO, you had to go out and buy Bitcoin. So from that point of view, you could absolutely have a nice run in Ethereum as more and more and more tokens get created off the ERC20 token, but a platform. But I will also say Ethereum's growing. I mean, Ethereum's growing pretty rapidly. I mean, about 18% a year. And if you have a high stake if you stake for proof of stake, you're making a lot of money off of that proof of stake if you're mining in the Ethereum network. So there's a lot of, it is increasing size pretty quickly. Ethereum Classic, on the other hand, has more of a scarcity to it, but it doesn't have anywhere near the security network that Ethereum has.
Chris, I've spoken with Matthew Edwards about a similar topic, and he also gave a very similar answer, talking about the value of Ethereum. The way they think about it is looking at the growth of the network, the growth of network usage, the growth of number of people.
Yeah, we really haven't talked about Metcalfe's law, and that's really what that's what drives Bitcoin. That's what drives Ethereum, and a lot of Ethereum is the value of that. So,
okay, again, for the people on the call who don't know Metcalfe's law, give us a short version of that.
let's see, it's n times n minus 1 to the n minus, or to the nth power divided by n. It's what judges the value of a network. If you Google Metcalfe's law, it comes up. You can see the equation. It's a very simplified equation, but it actually gives a certain value to Bitcoin through number of, and Ethereum and others that are utilized through the number of wallets, through the number of miners, through the number of nodes, all of the different ways that you can apply Metcalfe's law.
So for the people on the call who don't follow this stuff, I think maybe the right analogy is to think about when you first saw a fax machine. If you were the only person in the world with a fax machine, it had no value. The more people who had a fax machine, the more value your ability to access that network had. Would that be a good analogy, Chris?
Yes.
All
or
right.
even, I mean, email is the kind of one that we tend to.
Email.
Exactly. Right. If you can only email 3 people, it's not worth buying a computer.
Yeah,
That's right.
The other important part to that question is the more valuable the network, the more costly it is to attempt to attack it, and so the more secure it comes. More secure it becomes. That's a whole lengthier conversation, but that is just I think a concept that folks can internalize a bit, is just the cost required to attempt an attack on a network increases with the value of that network. So the security of the network increases with the value, which is,
Great.
implicit.
Great point. Michael, I'm going to come to you with Adam's last question, and it's going to be our last question in the call. When you trade crypto on a centralized exchange, something like Coinbase, Binance, Gemini, do you benefit from any sort of consolidated order book, or do you just access buyers and sellers based on that particular exchange? If it's the latter, does that mean there's a lot of arbitrage profit to be had between exchanges?
So there have been moments in time where arbitrage has existed literally in manually entering trades in times that are hyper volatile, like end of 17 and March of 2020. People do it systematically. We think that sort of the juice left in that squeeze is not as attractive as it once was. With respect to trading, we have focused immensely on our operational and trading infrastructure. So we do leverage smart order routers, we leverage exchange aggregators, but we also go direct. We're plugged in directly to 30 plus exchanges. We have, about 12.5 OTC relationships on the spot side, about 6 on the derivative side. We're plugged into a number of derivative exchanges, both unregulated and regulated. So absolutely, aggregation of order books is useful. Some of it we do it in a proprietary fashion, where we're pulling data directly from those exchanges that we're plugged into. In other instances, we're using different providers. So, for example, we have been very active in the DeFi space. We launched it was one of our co-investments, so not a new. It was misreported by, I think, Axios, that we launched a DeFi fund. It was a co-investment vehicle to tap into the small mid-cap liquid DeFi space. It was about 25, we capped it at $25 million. We allocated to the space. We do a little bit of light trading and a lot of ecosystem participation and yield farming, but to put those positions on, to put on small and mid-cap DeFi in any meaningful size is quite difficult to do it kind of, manually. So we leveraged a company called Dexable, which creates both aggregation of exchange flows, but also proper reporting and a lot of the things that we depend on as an investment firm, as well as solves for bot front running. So that was the kind of the key IP solution that they created. In DeFi world, you're getting every trade because your trades are being brought. It's a swap. So your trades are being broadcast to the network before they're actually being put on, and bots will front run you. So they created efficiencies around that. So there's the alpha generated by asset selection, by overall portfolio construction, and then quite meaningfully by execution, almost to the kind of, think of equity hedge funds in the 90s before algos were even a thing. So there is a lot of execution alpha to be had if you're kind of thinking about it in the right way.
Yeah, actually, I remember back in the early 90s doing risk arbitrage, there were rare occasions when you had the ability to buy the stock of a company that had already been acquired in a cash deal after the press release had gone out saying the deal had closed. You basically buy quarters for free, knowing that the deal had already closed. Same kind of thing.
Yeah.
I don't think those kinds of opportunities are available anymore. And in another 10, 20 years, they may not be available in the crypto space either.
There's a small amount of arbitrage that's still available in countries. For a long time, in South Korea, the price of Bitcoin was substantially trading, a good 5, 6, 7% higher than in the more liquid markets. And the same cases in African nations. It was, trading at one point in Nigeria at about, 12% higher than in most of the markets. But I think, Michael would know better than me, as most of that's been arbed out, hasn't it?
Yeah, most of it's arbed out. Some of it's structural. So, for example, Korean exchanges in bull markets will tend to trade at a premium that's known in the industry as the kimchi premium. That's a function of capital access, right? So you can't pull your capital back from Korea. So large prop firms, so the largest prop firms that we all know and love, and Jump, Acuna, Susquehanna, Jane Street, they're all doing this because they have operations and partnership, and it's a nice sustainable cash flow business for them. You can participate in it. They usually exist for a reason. Outside of those moments of hyper volatility, if they're sustainable, they exist for a structural reason, and you need to assess whether the risk of being, of owning Bitcoin on a random Nigerian exchange is worth the spread you're making on a trade.
Yeah, right.
Got it. All right. Well, this is a great place to wrap up. Before we go, I want to thank Matthew Edwards, the CEO of Dalpha Capital. Again, he was supposed to be on today's call. He's a great person to talk to. He's one of the people I go to when I have questions about crypto. Couldn't be on because of a dental emergency. Want to thank Michael Bodley of the Street Crypto and their flagship publication, Crypto Investor, for covering the call, sending in questions. Really glad to have you on. Chris Bell of Horizon Kinetics, terrific to have you as well. For anybody who's interested in Horizon Kinetics or their crypto fund, just shoot me an email at ir@deepknowledgeinvesting.com. I'll put you in touch directly. And finally, want to thank Michael Bucella, one of the founding partners of Block Tower Capital. Again, fantastic crypto fund there. Anyone who's interested in their products, again, ir@deepknowledgeinvesting.com. I'll put you directly in touch with Michael, and you can have whatever conversation is appropriate for you. Guys, thanks so much for being on the call. Thanks for the time.
Thank you.
My pleasure. Thanks.